On March 19, 2003, the United States launched its invasion of Iraq. The sky over Baghdad lit up with cruise missiles. The world watched in shock. And the next morning, the American stock market did something completely irrational. It went up. It didn't just go up a little, it rallied, and it kept rallying for months. But this wasn't a fluke. When Germany invaded Poland in 1939, kicking off the deadliest conflict in human history, the Dow Jones Industrial Average jumped nearly 10% in a single day. When the Korean War started, stocks climbed. When Russian tanks rolled into Ukraine in 2022, the initial panic lasted barely a few weeks before the defense, energy, and commodity sectors exploded upward, dragging the broader indices along with them. We're raised on a very simple, logical equation. Peace is good, war is bad. Therefore, war must be bad for business. It destroys infrastructure, it severs supply chains, and it wipes out the workforce. By every human metric, a war should crash the global economy. Yet, time and time again, the very moment the first shot is fired, the stock market breathes a massive collective sigh of relief. To understand why this happens, you have to look at the system not as a moral compass, but as a machine. And you have to understand the one thing this machine hates more than anything else in the world. It is not death, it is not destruction, it is uncertainty. The stock market is a giant, heartless pricing engine. Its only job is to look into the future, guess what is going to happen, and assign a dollar value to it. When politicians are arguing, when troops are massing on a border, the machine freezes. It doesn't know how to price maybe. Maybe there's a diplomatic solution. Maybe there's a nuclear winter. The financial gap between those two outcomes is impossible to calculate. So investors panic. They sell. The market bleeds. This is the build-up. But the second the invasion actually begins, the maybe disappears. The worst-case scenario is no longer a shadow in the dark. It is a known variable. The machine can finally do its math. And the math of war is incredibly lucrative. When a nation goes to war, it stops worrying about balancing the budget. The government simply opens the vault. Suddenly, there is infinite demand for very expensive things that are explicitly designed to be destroyed and replaced. Missiles, drones, artillery shells, aviation fuel, medical supplies, logistics software. This is not an economic disruption. It is a guaranteed multi-billion-dollar injection of capital directly into the private sector. It is the ultimate economic stimulus package wrapped in a flag. And today, that stimulus goes far beyond traditional defense contractors building tanks. Modern war is fought with data. It is fought with cloud computing, artificial intelligence, and low Earth orbit satellite networks. The Pentagon doesn't just write checks to Lockheed Martin and Raytheon anymore. They write them to Amazon, Microsoft, Palantir, and SpaceX. War accelerates technological spending, and the stock market heavily weighs the tech sector. But there is a deeper, more uncomfortable mechanism at play here, something the financial headlines rarely talk about. War is inherently inflationary. Governments almost never pay for wars by raising taxes. Raising taxes to fund a war makes citizens angry, and angry citizens stop supporting the war. Instead, governments borrow, they issue debt, they expand the money supply to keep the war machine turning. When a government prints money, the value of the currency drops, inflation rises. If you're a wealthy investor sitting on a pile of cash during a wartime economy, you are committing financial suicide. Inflation will eat your purchasing power alive. You are forced to put that money into hard assets to protect yourself: real estate, commodities, and most importantly, stocks.
The stock market isn't necessarily hitting all-time highs because the companies are suddenly fundamentally better. The market is going up because the currency you are measuring it in is becoming worth less. The numbers on the screen get bigger, not because wealth is being magically created, but because the measuring stick is shrinking.
This is where the profound disconnect happens. If you watch the news, you see tragedy. If you watch the ticker, you see triumph. The reality of war is intensely local. If a bomb drops on a factory, that factory is gone. The people who worked there are gone. The local economy is devastated. But the stock market is not local. The S&P 500 does not live in a war zone. It lives in server farms in New Jersey. When a foreign factory is destroyed, domestic competitors instantly gain market share. When a pipeline is blown up, energy companies on the other side of the world see their profit margins double overnight. The physical destruction is localized, but the financial profits are globalized. The market doesn't care about the broken windows because it is heavily invested in the glass company that just secured the government contract to replace them. There is a dark, absurd irony to all of this. The worse things get on the ground, the more central banks and governments intervene to make sure the financial system doesn't collapse. When a crisis hits, governments lower interest rates, they provide emergency liquidity, they backstop failing institutions, they essentially build a financial fortress around the investor class. War forces the government to guarantee the survival of the market. They effectively eliminate the risk of a catastrophic crash for those who own assets. The people fighting the war bear all the physical risk. The people funding the war bear almost no financial risk. But there is a catch, a massive glaring caveat to this entire phenomenon. The stock market only loves war if the war is far away. This entire dynamic relies on the distance factor. The American stock market rallies during global conflicts because the United States has spent the last century fighting its wars on other people's continents. The U.S. exports the violence and imports the defense contracts.
When the war is on your own soil, the math flips. Look at the German stock exchange in 1945. Look at the Russian market in 2022, which had to be halted for weeks to prevent a total wipeout. If the bombs are landing on the companies that make up your index, your market goes to zero. Capital is entirely unsentimental. It does not have patriotism. It simply flees the blast radius and sets up shop wherever it is safest. Now, zoom out. Look at the geopolitical landscape today. We live in a heavily financialized world. Our retirements, our pensions, our institutional wealth are all entirely dependent on the stock market going up quarter after quarter, year after year. And the market has learned a Pavlovian lesson over the last century. Conflict brings cash. Conflict brings government spending. Conflict brings central bank bailouts. If capital is consistently rewarded for geopolitical instability, we have to ask a very uncomfortable question. What is the financial incentive for peace? Peace is cheap. Peace doesn't require emergency trillion-dollar spending bills. Peace doesn't justify massive deficits or infinite money printing. Peace is steady, boring, and fundamentally deflationary. The financial system doesn't necessarily want the world to burn, but it has absolutely figured out how to profit from the sparks. The machine is functioning exactly as it was designed to. It separates emotion from capital, and it prices tragedy as an opportunity. The market will always go up as long as the war is happening somewhere else. The only thing the machine hasn't priced in is what happens when the war finally comes home.